Okay, so let's get right into it. So what are some of the common commercial property types? Okay, so here are the three examples that everybody knows about, the office buildings, the industrial buildings, and the retail complexes. So these are probably your most common commercial property types. But there are other commercial property types as well, such as hotels, pubs, recreational, and there's more. And under the commercial property umbrella, there are also other specialized property types, such as car parks, education facilities, rural farming properties as well. And finally, there are institutional grade commercial property types as well. And these could include mines, could include infrastructure, could include transport and ports as well. So usually these type of assets are in the billions of dollars, which appeal to institutional investors. So all these property types fall under the commercial property umbrella. So what are some of the commonly used commercial property terms? So I'm going to go through about a dozen of these commonly used commercial property terms or jargon, so that you're up to speed with how commercial properties work. Okay, so the first one, the most obvious one, is SQM, which stands for square meter. Basically, everything in commercial properties is measured in square meters, unless you're in North America or in the US where you're still using square feet. But essentially, everything is measured in square meters, and it starts and stops there. The next term that's commonly used is yield, but more importantly, the difference between net and gross yield. Okay, so gross yield, well, what is yield? Yield is the percentage return based on the value of the asset. So for example, the asset is worth $2 million and you're receiving $100,000 in rent or in income, then that probably offers you a 5% yield. Okay, but the difference between gross and net is gross yield includes the outgoings, the property outgoings like land tax, council rates, roll rates, insurance, etc. Whereas net yield excludes the outgoings and just the rental. So I'll give you an example. Let's say we're looking at a property that's worth $2 million. The rent that's being paid at the moment is $100,000, and the outgoings payable on this property equates to $30,000 a year. Then the gross yield will be the rent, $100,000, plus the outgoings, which is $130,000, divided by the value of the property, which is $2 million, and that equates to 6.5% gross yield. Whereas net yield only takes into consideration the rent. So it's rent, which is $100,000 divided by the value of the property, $2 million, equals 5% net yield. So it's very important to know the difference between the gross and net yield, so that when you're doing your calculation, you're doing feasibility, you're putting the right figure. Now, as a side note, it's also important to understand the difference between a gross rent agreement and a net rent agreement. Now, a lot of investors are led to believe that the tenants, commercial tenants, pay all the outgoings on behalf of the landlord. Now, that is true in most cases, but in some cases, that is not true. Okay, so if the tenant has agreed to a net rent lease or net rental structure, then yes, what they do is they'll pay you, the landlord, the agreed rent, and they'll be responsible for the outgoings as well. However, if you've agreed to a gross rental structure, then all they're going to do is pay you the rent, and then you're responsible to pay the outgoing. So it's very important to understand the difference between the two. And when you are going through a lease document, make sure you identify whether it's a gross or a net lease structure. Okay, so next term is the cap rate. So the cap rate is the capitalization rate, which is the rate of return or net yield that the property is expected to generate. Okay, so for example, Let's say we're looking at retail properties in Sydney CBD, and we identified that the average net yield for this type of property is 5%. So therefore, we can adopt that a cap rate of retail properties in Sydney CBD is 5%. So that's the expected rate of return. Another example will be, let's say the average net yield for commercial properties in Brisbane Metro is 6%. Therefore, we can adopt that the cap rate for industrial properties in Brisbane Metro is 6%. Okay, vacancy rate. So vacancy rate is basically, what are the percentage of properties that are vacant on a market at any given time. So it's the same as residential property. But with commercial property, it's very important to also understand the vacancy rate for each asset type and the sub-segments of the market. So what I mean by that is, let's say the vacancy rate across all office space in Sydney CBD is 9%, right? Then, then you can probably say that, yeah, the Sydney CBD vacancy rate is 9%. However, if you are looking at a specific sub-segment of the office space in Sydney CBD, you may find that the vacancy rate in B-grade offices that are under 500 square meters is 7%. Okay, or perhaps if you're looking at vacancy rates in A-grade office space between 1,000 and 3,000 square meters is 11%. Okay, and this can be applied to all different asset types as well, retail, industrial, et cetera, et cetera. So why is this important? Is because each sub-segment of the market has its own drivers and its own stories. Okay, so as a sophisticated investor, it is very important to know the ins and outs of each sub-segment as well. The next thing to understand is incentive. Okay, so what are incentives? So incentive is a tool used by building owners to entice businesses to lease their space within their property. Okay, so what are some of the common incentives? And some of these you'd have heard of. These include rent-free periods, fit-out contributions, lessor works, et cetera, just to name a few common ones. And incentive is usually expressed as a percentage. So what I mean by that, so let's say you've agreed to a 6-month rent-free period on a 60-month term, then that means the incentive that's been agreed equals to 10%. Okay, another example is, let's say you've agreed to a 3 months rent-free period on a lease term of 2.5 years, which equates to 30 months, then the incentive agreed is equivalent to 10%. Okay, now that you understand incentive as a percentage, it's also worth noting the difference between effective rent and face rent. So what's the difference? So face rent is what is written down as the rental payable irrespective of the incentive, and effective rent is the actual rent that the tenant is paying, which factors in the incentive that they're receiving. So as an example, let's say the rent agreed is $100,000 per annum, and you've agreed to a 5-year lease term and the incentive 10%, then the face rent is $100,000. Okay, but the effective rent will be $100,000 minus 10% because you're giving away 10% incentive. So the effective rent is $90,000. Okay, so again, when you're going through tenancy schedules, when you're analyzing properties to buy, it's very important to distinguish between face and effective rent. Zoning. So zoning is basically, what zoning means is, lands are subdivided into zones in order to control how much land is used, including how much space can be built on it, and what type of buildings can be built on it, and what type of businesses are allowed there. Okay, so some of the most common zonings, they include like mixed-use zonings, industrial zonings, residential zonings, town centers, etc. Okay, so basically zoning means what is allowed to be built on the land and what type of business is allowed to operate from this property. So, for example, you can't build a residential property inside an industrial zoning. Okay, so if you bought an industrial piece of land, you won't be permitted to build a residential property on top. Or, another example is you can't have heavy manufacturing businesses inside a residential zone. Okay, so zoning governs what can and can't be done on the property. Options. Okay, options is something that is used very regularly in the commercial properties arena. Okay, so there's a few different types of options. So the first one is a lease option. Okay, so lease option gives the option holder, and 99% of the time is the tenant, the right to extend the lease beyond the current term. Okay, so as an example, you might have seen these in the past. There are tenants that sign a 3+3+3 year lease or a 10+5 year lease. What that basically means is they've agreed to an initial term of 3 years, but they also have the option or the right to extend their lease for another 3 years and another 3 years after that. Or in this example, they've agreed to an initial term of 10 years and an option to renew the lease for a further 5 years. Now, it's very important to understand that 3+3+3 years doesn't mean a 9-year lease. Okay, so a lot of investors make the assumption that because a tenant has an option, that they're going to stay. That's completely false. The lease option gives the option holder, which is a tenant, the right to extend their lease. It doesn't give the landlord the right to enforce the tenant to renew the lease. Okay, so it's a little bit misleading if an agent tells you that a 3+3+3 lease is a 9-year lease, because it's not. Okay, the second type of option is a purchase option. So there are two types of purchase options. There's a put option and a call option. A put option gives the vendor, the seller, the right to force the buyer to purchase the property at a price that was previously agreed. Okay, and a call option gives the purchaser the right to force the vendor to sell the property to the purchaser at a price that was previously determined. Okay, so put and call options are similar to shares. And then finally, you have lease plus purchase option. Okay, so basically what this is an additional clause in the lease giving the tenant a call option. So practically how that works is, let's say the tenant signed a 5-year lease and they have a purchase option which they can exercise at any time during a 5-year term. And that means that at any time during the 5 years, they can exercise the option and buy the property from the vendor or from the owner. Okay, excuse me. Okay, next one is rental review. Okay, so rental review simply means at the anniversary of the lease, how is the rent going to be adjusted? Okay, so it could be every anniversary, it could be monthly, it could be biannually, whatever you've agreed with the tenant. But the most common rental review is annually. Okay, and there's a few different types of rental reviews. Okay, so you've got the fixed reviews, which are usually expressed as a percentage. So it could be a 3% annual increase, 4% or 5% annual increase. There's also CPI reviews. So the rent gets increased in according to what the CPI is on the previous year. So at the anniversary of each year of the lease, the rent goes up by the percentage indicated by the CPI. And there are also market reviews. Okay, so market reviews basically looks at what the current market rent is for that particular asset type. Okay, so why is this important? Because sometimes market rents grow at a faster pace than your fixed reviews. Okay, so if you sign up a tenant on a long-term lease, sometimes it is advantageous to have a market review so that the market rent doesn't run away from what the tenant is paying too much. Okay, so there are a few types of market review. So there's an open market review, which means whether the market goes up or goes down, the new rent is adjusted in accordance to whatever the market rent is at the time. There could also be a ratchet market review, which means that the new rent can only go up. It cannot go down. It cannot go below what the tenant was previously already paying. Okay, it's like a ratchet. If you guys know what a ratchet is, it only goes. It's a tool that only goes one direction. And then there's also a cap and collar, which means that the market review cannot exceed a certain amount, which is a cap, and it also cannot go below a certain amount, such as a collar. Okay, so for example, it could be an open market review with a cap of 10% and a collar of 10%. So which means the rent cannot go above 10% of the previous year, it cannot go below 10% of the previous year. Okay, so give an example. Let's say you've agreed to a 4% annual fixed review with a market review year 6. Okay, so let's say the starting rent is 100,000. So in year 2, you add 4%. In year 3, you add 4% of the previous year. Year 4, you add 4% of the previous year, and so forth. And then in year 10, you have a market review. So let's say the market's gone up 10% at the time. Then you can see that the rent's been adjusted in accordance to what the market rent is in year 6. As you can see, there's a 10% increase here. Okay, DA, development application. So development application is a formal application submitted to your local consent authority, or AKA council, for permission to carry out a new development. Okay, so what is a new development? So new development doesn't necessarily mean building a new building. It could also be just changing things inside the building. It could also refer to what is the approved usage. So for example, if you're looking at leasing a property, it was previously a newsagent, and now you want to put in a dental practice in there, then that will be considered a new development. Okay, so it's approved usage, conforming usage, which means let's say there was a dental practice in place, but they moved out recently. But because it already has a conforming use, then you can just move in straight away if you want to use it as a dental practice. You've also got approved developments, which is literally doing some sort of building works, renovations, extensions, or building something from scratch, or perhaps an approved change of use. So as an example that I've just used, you want to change something from the was before, let's say news agency, to a dental practice, which is a change of use. Because all that will require a DA. And finally, WALE. Okay, what is WALE? WALE stands for the weighted average lease expiry. The weighted average lease expiry is used to indicate the average expiry period of all the leases within a property. The WALE is commonly used to assess the income risk profile of an asset. Okay, so for example, I demonstrate what I mean by this. So let's say you own a property with 3 tenants in place. You've got tenancy A, B, and C. Tenancy A, their lease expires in 12 months. Tenancy B, lease expires in 20 months. And tenancy C, lease expires in 35 months. So the WALE will be the average of the 3. 12 plus 20 plus 35 divided by 3 equals 22.33 months, or 1.86 years. So just by looking at this, I can see that the risk profile or the income risk profile of the asset is 1.83 years, as in after 1.83 years, I might stop receiving income. Okay, obviously this is continually evolving as you renew leases and get new tenants. But if you're analyzing a property as a snapshot, a WALE is a really good indication of what your risk profile is. Banks and valuers very often refer to WALE to assess the risk profile of the asset when they're determining lending and things like that. Now, you can also calculate WALE by lettable area. And you can also calculate WALE by income as well. So which would then give you an indication of how many square meters inside my building is up for expiry, and also in terms of income as well.